you have investment capital, and then you have your human capital. And your human capital, that sort of consistent paycheck, is basically like being long a bond, sort of typically an inflation protected bond, probably has a little bit of credit risk to it. Maybe if you're at a great company, it's an investment grade bond, right? So your human capital, the thing that gives you a paycheck, is like having a massive bond in your portfolio. You actually could, if you wanted to, sort of figure out, okay, I'm going to get all these distributions over the next, until my retirement. What is that? What's actually the net present value of that bond? What's the duration of it? And you can model it as a bond. Conversely, all those liabilities in the future, those are bonds you're short. That retirement, all that spending in retirement, that's sort of a bond that starts 20 or 30 years out. Those are your liabilities. Those are bonds you're short. Most people, right, when they're young, have way more of their capital tied up in their human capital. That net present value of all that future earnings is really big, and it's a big bond position. So they probably should have a massive stock portfolio, right, in their investment side. Conversely, as you get older, right, that human capital goes to zero. And there's a reason you probably don't want to have just stocks in your portfolio anymore, because now you're totally unbalanced, and that's why your glide path starts to introduce bonds.